Hey everyone, welcome back to Corporate Decoder, the place where we unpack the nitty-gritty of corporate filings, and today we're diving into Wynn Resorts' latest quarterly report, a look under the hood of a huge casino operator. Alright, so Wynn Resorts just dropped their Q2 2025 report, and it's a story of mixed fortunes for this casino giant. First off, let's look at the big picture, the balance sheet. As of June 30, 2025, Wynn Resorts has total assets valued at a staggering $12.7 billion. That's down slightly from the $13 billion it had at the end of 2024. Now, for the good news, they're holding on to pretty healthy cash reserves with almost $2 billion in cash and cash equivalents. That's down from the $2.5 billion they had at the end of last year, but still a strong position. But here's where things get a bit heavy. Wynn Resorts carries a massive amount of long-term debt. As of June 30, 2025, it stands at over $9.5 billion. This is a significant decrease from the almost $10.5 billion they had at the end of 2024. It seems they've been paying down their debt, which is a positive sign for financial health. Now, let's talk about the bottom line. For the second quarter of 2025, Wynn Resorts reported a net income attributable to them of about $66 million. This is a sharp decrease compared to the $112 million they earned in the same period last year. That's a drop of nearly 41%. This translates directly to their earnings per share. For Q2 2025, the diluted earnings per share came in at 64 cents. That's a big drop from the 91 cents they reported in Q2 2024. Looking at the first 6 months of the year, the trend is even more pronounced. Net income attributable to Wynn Resorts for the first half of 2025 was about $139 million, down significantly from $256 million in the first half of 2024. And their diluted earnings per share for the first half reflects this, falling from $2.30 last year to just $1.33 this year. That's a nearly 43% drop. So what's behind this dip in profits? Well, the casino revenues actually saw a slight increase in the second quarter, going up by about 433%. But the non-casino revenues like rooms, food and beverage and entertainment took a hit, falling by over 5%. This suggests that while people are still gambling, their spending on other services is down. In Macau, at Wynn Palace specifically, their table games win percentage dropped slightly from 23.6% to 22.3%. This means they kept a bit less from the money bet at their tables compared to the year before. However, their slot machines are performing better, with slot machine win per unit per day jumping by over 22%. So clearly their slot machines brought in more money per machine. Across the first 6 months for their Las Vegas operations table drop, which is essentially the money bet at the tables, increased by a healthy 5, 4 and 4%. This indicates a good volume of play in Vegas, and their slot machines in Las Vegas also saw a nice boost, with slot machine win increasing by over 17% for the first half of the year. When we look at their segment performance, adjusted property EBITDA, which is a key metric for casino operators, shows a decline. Wynn Palace, for example, saw its adjusted property EBITDA drop by almost 15% in the second quarter and by over 17% for the first half of the year. This metric essentially measures the operating profit of their properties before many corporate level expenses. This decline at Wynn Palace is attributed to lower room revenues and higher operating expenses. Wynn Macau, however, showed a slight increase in adjusted property EBITDA for the second quarter, driven by higher casino revenues, but a notable decrease for the first half of the year due to lower casino revenues overall. Their Las Vegas operations, however, showed resilience, with a slight increase in adjusted property EBITDA in the second quarter. This is thanks to higher operating revenues, although expenses also went up. For the first 6 months, Las Vegas operations saw a dip in this metric, mainly due to rising operational costs. Financially, Wynn Resorts has been active. In June, they entered into an amendment to their credit agreement, extending maturity dates and allowing for more revolving credit. This is a strategic move to give them more financial flexibility. Looking at liquidity as of those June figures, their cash and cash equivalents provide a solid buffer, even though it's lower than the end of last year. They have almost $2 billion in cash and over $1.5 billion in available revolver borrowing capacity across their main finance entities. This means they have good access to funds if needed. Interestingly, the corporate and other segments assets have decreased slightly from $2.8 billion to $2.6 billion. Looking at the filing, the corporate and other segment saw its adjusted property EBITDA decrease for both the second quarter and the first half of the year. This seems linked to them ceasing their digital sports betting and casino gaming operations in the third quarter of 2024. Now, for the risks. The report doesn't seem to show any major new risks, but it did mention that on August 7, 2025, they announced a dividend payment indicating continued shareholder returns. When it comes to legal matters, the company states that it's involved in litigation arising in the normal course of business, and that this litigation is not expected to materially affect their financial condition. The company also has various debt instruments outstanding, all maturing at different times. For example, they have these 7 and 1/8% senior notes due in 2031. One notable mention is the potential impact of new US tax reform legislation signed into law on July 4, 2025. The company is currently evaluating its effect on their tax rate and deferred tax assets. So what's the story here? Wynn Resorts is navigating a slightly tougher economic climate, while their core casino operations in Macau are showing some mixed results, and Las Vegas and Encore Boston Harbor hold steady. Their overall profitability is down significantly, primarily due to factors outside their core gaming like currency fluctuations and changes in derivative values. The company is actively managing its debt load and seems to have adequate liquidity. However, the drop in net income and earnings per share is a clear signal that they need to find ways to boost non-gaming revenues and improve efficiencies. The closure of their digital betting business also had an impact on their corporate segment. Now, looking at these numbers more broadly, Wynn Resorts is clearly a massive player in the integrated resort space. They are showing signs of prudent financial management by paying down debt and maintaining good cash reserves. However, the dependence on Macau, which had some weaker performing segments in this report alongside rising costs in other areas, are areas to watch. The decline in profitability isn't catastrophic, but it's a trend investors will want to see reversed. They need to either increase their take from casinos or find ways to significantly cut costs across the board, especially in their non-gaming operations. Alright, that's our breakdown of Wynn Resorts' latest filing. What's your take on these numbers and what they signal for the company's future? Do you think they can turn things around, or are we looking at a period of struggle? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.